you ready to transform your financial dreams into reality this year? Whether you're looking to build wealth, prepare for retirement, or just increase your financial security, understanding the best beginner investment strategy is a first step towards financial freedom. In 2024, the landscape of investing is more exciting than ever, with a host of options tailored to help beginners embark on a journey towards riches. Let's dive into the smart strategic approaches that promises not just to preserve your hard-earned money, but to significantly multiply it. Hey everyone, welcome back to Brain and Bank. If you're new here, I'm Jom, and this channel is all about helping entrepreneurs like you master marketing, branding, and financial management. To all our returning subscribers, thank you for your continued support. Let's dive into today's topic and take your business to the next level. Have you ever imagined yourself to be financially independent? Well, it's possible, and the secret is not found in a treasure chest. It's found in beginning your investing path early. Indeed, investment is for you too, not only for the big players, even if you're barely out of college or starting your first job. You could be thinking, but I have little money to start with right now. That's precisely where compound profit power is most evident. Consider your money like a snowball sliding down a hill. The earlier you roll it, the larger it gets by the bottom. This is because your initial investment begins to pay off, and these returns also create their own returns. This effect lets your account balance increase exponentially with time. The even more fascinating thing is that starting smaller has never been simpler. Thanks to modern investing platforms. Platforms today provide minimal or zero minimum investment, zero commission fees, and even fractional shares regardless of $50 or $500 without having to pay a large upfront cost. You can invest in a broad range of choices, including mutual funds, ETFs, and index funds. Let's consider a real life scenario with an average yearly return of 6% over 10 years. You would have increased your starting investment to roughly $33,300. Assume you are spending merely $200 a month. Your entire input out of this is $24,200. The remaining $9,100, that is all interest money your investment generated simply by themselves. Here's another narrative that helps us to see this. Certified financial advisor Brent Weiss of St. Petersburg, Florida, co-founder of Facet, stresses that it makes no difference how much you're contributing. $5,000 a month or $50 a month. Making consistent donations that fit your own goal and financial position counts the most. I now must question, have you ever experienced the excitement of seeing your money increase? If not, why not begin today? Recall that the stock market will fluctuate, but investing young allows you the luxury of time. You have decades to wait out any volatility and see your money grow. What then is keeping you from moving forward? Perhaps you don't know where to start. Well, Investopedia and other websites provide a lot of information, and also apps like Robinhood helps you start trading without even feeling overburdened. Invest in stocks. Think about this. Almost everyone should own a stock or stock-based investments like exchange traded funds, ETFs, and mutual funds. Why? Because historically, stocks have been the golden ticket to building wealth. It's not just a claim, it's backed by decades of data and the experience of countless investors. Let's dive into some numbers that highlight the power of investing in stocks. Over the past 4 decades, US stocks have outshined bonds, savings accounts, precious metals, and nearly all other forms of investments. They have not only delivered stellar returns over almost every 10-year period in the last century, but have also averaged annual returns of 9% to 10% over these long stretches. Imagine investing $10,000 at a 10% annual compound rate. In 30 years, that initial sum balloons into almost $175,000. Now, that's what turning time into money looks like. But why have US stocks performed so well? The answer lies in what owning a stock means. You are not just buying a piece of paper, you are buying a piece of a business. Consider owning shares in powerhouses, companies like Apple, Google, or Amazon. Holding their stocks means you legally own a part of these titans. As they expand and profit more, your shares of this growing pie increases in value. It's akin to being a silent partner in some of the most successful businesses in the world. Legendary investor Warren Buffett described investing in US stocks as betting on American business. And if history is any indication, this has been a remarkably successful bet over 2 centuries. Furthermore, many stocks pay dividends, adding a steady income stream to your investment returns. These aspects make stocks particularly attractive for those seeking not just growth, but also income from their portfolios. And let's make this more relatable with a story. Imagine a young investor named Emily. She started small, investing in a few shares of technology stocks. Over the years, as companies like Google, Amazon flourished, so did Emily's initial investments. Her portfolio's growth wasn't just numbers on a screen, it was her future security becoming more robust. You might wonder if now is a good time to start. Consider the broader perspective. While the market has its ups and downs, the long-term trends of the US stock market has been upward. Starting sooner rather than later allows you to maximize the benefit of compound growth. So, do you see yourself as an Emily ready to grow your wealth through stocks? What companies excite you and how do you plan to pick your investments? Share your thoughts in the comments. I'm excited to read about your strategies and answer any questions you might have. Invest in exchange traded funds. For good reason, investors have become increasingly fond of exchange traded funds, ETFs. They provide a hard to equal mix of simplicity and variation. Every ETF lets you make investments in a wide range of securities covering hundreds of various asset classes. This is amazing when you consider it since you may have a slice of a whole sectors or economies in just one investment. ETFs can be purchased and sold during the trading day exactly like stocks, unlike mutual funds, which are only transacted at the conclusion of every trading day. This adaptation lets you respond faster to change in the market. Furthermore, an ETF is a great choice of diversifying your portfolio even with a small budget since you can purchase one for the price of a single share. To grasp the influence, let us now explore some actual figures. From 1926 through 2022, the compound annual rate of return for a diversified portfolio of big equities, such as those in the S&P 500, was 10.3% according to historical data from Ibbotson Associates. Imagine the possible increase over time. Furthermore, keep in mind that a diversified basket of minor stocks has historically produced even more remarkable outcomes if you are considering going for even bigger returns. Over those 97 years, tiny stocks showed a compound annual return of 11.8%. These numbers highlight the impact of wise investment decisions. Where then should you start? Tools available on sites like JP Morgan self-directed investing let you access and select the best ETFs for your particular financial objectives. Other sites, including Vanguard, Fidelity, and Charles Schwab, also offer a large range of ETFs choices with easy to use layouts and instructional tools to help you. For those with long view, Robert R. Johnson, PhD, a professor of finance, suggests investing in diversified, low-fee index funds. Over a century of stocks market experience, he contends that this strategy has shown success. ETFs also go beyond stocks in general. They comprise growth stock, dividend stocks, value stocks, foreign stocks, and sector-specific funds, including technology and healthcare. This diversity lets you fit your investment portfolio to your risk tolerance and particular financial objectives. Chief Investment Officer of New Frontier Advisor Robert Mouchard emphasizes the need of diversification. The future is too unclear for a single security or asset class, he remarks. To build a diverse portfolio best suited for long-term objectives, Mouchard advises a mix of stock and bonds ETFs. Combining a worldwide stock ETF with an aggregate bond ETF is a great approach to control risk for people without access to specialized ETFs. Invest in short-term bonds. Bonds have long been seen in the world of investing as a safer substitute for equities, providing consistent, if not outstanding returns. Long-term bonds have historically yielded more than their short-term equivalent, therefore repaying investors for the higher risk involved in locking in their money for longer times. But this seen in 2024 shows a different image, offering a special challenge as well as possibility for bond investors. Since long-term bonds carry more risk over time, their yields typically are higher. Currently, nevertheless, one-year Treasury notes yields 4.78%, greater than the 4.38% yield of the 30-year Treasury bond. Under this inverted yield curve, short-term securities 1 month to 1 year are yielding more than long-term ones, such as the 30-year bond and the 10-year note. Investors are worried about the short-term future of the economy. They expect higher interest rates soon, but not in the long run. And Chief Investment Officer of Baker Boyer National Bank notes, due to the situation of the bond market, you may get higher returns on shorter bonds with less interest. one should take great consideration on large opportunity costs. He cautions that the high short-term rates we are currently experiencing could plummet just as rapidly as they emerge should the Federal Reserve cut the Fed funds rate later in this year or the next coming year, as hinted at. Should you ride the wave of high short-term yields or invest in a long-term bonds to guard against future rate decline? This scenario forces a strategic choice for investors. Investors can guard against the prospect of declining rates by investing in somewhat longer bonds. Conningson counsels. Longer bonds yield will become more appealing in a falling rate environment and their price will rise more than that of shorter bonds. There is sense in keeping a balanced attitude. There's nothing wrong with having more in a money market than normal. Conningson notes. Just don't overdo it. This approach lets investors remain adaptable, maintaining liquidity and still grabbing better rates on short-term bonds. For you, the individual investors, though, what does this mean? Think about your long-term financial goals and risk tolerance if you're trying to modify your bond portfolio in view of these changes. Are you ready to hunt greater rewards with the related dangers, or are you seeking stability? Platforms like Vanguard, Fidelity, and Charles Schwab give a range of bond investing options from ETFs to individual bonds, therefore offering the tools and information required to make wise selections for everyone wishing to negotiate this inverted curve. Real estate. In a continuous argument between real estate and the stock market as the best long-term investment tool, 2024 still shows strong competition. Although both have advantages, real estate has special possibilities, especially with creative investing strategies like crowdfunding and real estate investment trusts. Investing in individual homes calls for active management and can be capital intensive. Real estate crowdfunding sites offer a good substitute, nevertheless, for individuals wishing to include real estate into their portfolios without the large initial outlay or administration problems. One of Finance Vice Manager Market Risk, Patrick Donogo, notes the attractiveness of this strategy. Historically, real estate has always been the best performing asset class. Private capital real estate acquisitions are among the best investments available. Our portfolio has shown steady 10% annualized returns with fractional real estate investing. For instance, you might commit $10,000, split $100 each into 100 separate ventures, and diversify yourself. By letting investors access properly maintained homes, real estate crowdfunding streamlines the investing process. Investing in real estate investment trust or REITs is another very attractive choice. Mostly investing in commercial assets like office buildings, retail stores, and sizable residential complexes. This money also reeled in 2023 brought an 11.7% return. Although this was behind the performance of the S&P 500 for the same period, the return is sufficient to make REITs a worthy component of diversified investment portfolio. With great dividend rates and the possibility for capital appreciation, REITs run quite like stocks. For investors looking to profit from a portfolio of properties, Instead of laying all your eggs in one basket with one property investment, this makes a great choice. For individuals ready to enter the real estate industry, Realty Mogul provides a strong portal. Realty Mogul uses a crowdfunding approach to enable the acquisition and sale of commercial real estate, therefore serving both accredited and non-accredited investors. Think about if real estate might fit your long-term financial plan when you decide on broadening your investment portfolio. Of all the features of real estate investing, which most appeal to you? Comment below your ideas and don't forget to like, subscribe, and click the notification bell for further intelligent material on wise investment decisions in the modern market. So that was all the time we had today. Hope you enjoyed this video. Do not forget to watch more of our amazing content. See you next time.